Hey moms, have you ever looked at your paycheck and thought, where did all of my money go? Well, that's taxes at work. They help pay for things that we rely on, like school, roads, emergency services, and so much more. Here's the thing, while we all want to pay our fair share, you shouldn't be paying more than you have to. The tax system can be confusing, and it can be easy to throw your hands up and say that you can't do anything about it. But right now, too many families are leaving money on the table because of common tax misunderstandings. Today, we are breaking down some of the most common tax misconceptions and misunderstandings. We also have some action items for you to take. So whether you are watching this video at tax time or at the end of the year, listen in closely and take action so that you can keep more of your money where it belongs, supporting your family during this time. Let's get started. Tax season is upon us, and in today's video, we are going to clear up 5 myths or commonly misunderstood facts about taxes. I have a special guest with me today, my sister and our resident accountant here at Sisters 4-Fi. She holds a CPA. She loves to educate anyone who will listen about taxes. So we are going to get some insight from her and hope we can clear it up so that you can save your family money and save yourself taxes. Thank you, Anna, for joining me today. Let's start with the most misunderstood fact. Is the tax refund a bonus? And should you be thinking of it as free money?
No, it is not a bonus. It is not free money. Every single year, every time you get paid throughout the year, what essentially happens is your employer is taking money away from your paycheck and putting it and setting it aside to be sent to the federal government. So as those numbers accumulate at the end of the year, that total does add up. And then when you file your taxes and factor in all the different calculations, if you owe less than what you've put in already, then you're getting a refund. So you're essentially just receiving the money that you put in throughout the year. So it's not a bonus per se. If you're living paycheck to paycheck and you're getting a large refund at the end of the year, I would make adjustments to your withholdings and see if you can get more money on a paycheck to paycheck basis rather than getting that large refund at the end and thinking and just splurging on something just because you have the money. So I would urge people to think about it and talk with your tax advisor or your tax accountant to see where you can adjust your withholding.
It sounds like there's also a lot of calculators you can use online to figure out what your withholding should be, which means what should your employer should be holding for taxes. And when you do adjust you'll actually go through your employer. Is that correct? You fill up a W-4, you submit it to your employer so that they can make those deductions.
Correct. Yep. You'll submit your W-4. So if there's changes to the family, if you have another baby, or if you have somebody who's no longer a dependent to you, you can make those changes on your W-4 and then it'll recalculate and adjust your paycheck accordingly.
Can you do that anytime during the year?
Yes.
What if you're just watching this video and you're like, wait a minute, definitely last year we received a lot in a refund and I just feel like we're struggling paycheck to paycheck each month. And I really want to get more monthly instead of at the end of the year. Can I adjust that withholding anytime?
Yes. You should just have to ask your HR department or whoever takes care of your payroll to give you the most updated W-4 form that they'll accept. And then you should be able to make it either a paper form or do it online.
And I think it's important for us to also just look at sometimes when we get the refund, it can feel like a big windfall. And we sometimes also don't know what that amount is. So we start planning ahead of spending that money. And that can be a dangerous territory when it could be used towards other things that can help on our day-to-day. The next thing that we will cover are tax brackets. So I think there is a misconception out there that if I earn $1 over the next tax bracket, all of my income is going to be taxed at that higher rate, which is why many people might be afraid to earn more money. Can you shed a little bit of light into the tax brackets and how it works and how you need to think of your income in relation to tax brackets?
The tax bracket system in the US is a progressive system. For example, for a married couple filing jointly, your tax rate for the first, and I'm talking rough numbers here, the first $23,000 of taxable income, you're going to get taxed at a 10% tax rate. Anything above that, up to 94,000, you're going to get taxed at 12%. So that first 23,000 is still taxed at 10%. And then that next set of, call it say 70,000, it's taxed at 12%. And then anything above that is taxed at 22%. So it's a progressive tax rate. So as you keep filling the different buckets, your tax rate gradually goes up. The maximum it goes up to is 37%. And that's if you earn 731,000 and higher. A lot of people will max out at 22%, which is essentially from 94,000 to $201,000. Your effective tax rate essentially is a blended rate. So the maximum rate you would get is the 22% for that 94,000 to 201 range. But blended between the 10, the 12, and the 22, you're probably going to fall in within a 15% tax rate.
The tax brackets are listed and issued by the government yearly, so it's good to look at it every year to see where you might fall or where your income might fall, depending on the year. It is updated and adjusted, so take a look at that so you know what part of your income is being taxed at the higher rate. The next thing that we will look at is standard deduction versus itemized deductions. Now, the standard deduction is a specific dollar amount that reduces the amount of income from which you're taxed. So for example, if you make $100,000 as your income and your standard deduction is $20,000, then $80,000 is your taxable income, which is the income that could be taxed. Can you talk a little bit about standard versus itemized deductions? When should you do one versus the other?
So there's a calculation that goes into if you do an itemized deduction, and as it clearly states, you actually have to itemize what deductions you're taking. So there's certain limitations for state and local taxes that are currently capped at 10,000. And then there's also interest deduction you could take, medical expenses, charitable donations. I think those are the bigger items, but those add up to more than the standard deduction. So for 2024, the standard deduction for a married couple filing jointly is $27,700. So if your itemized deductions, that means your state and local taxes at 10,000 plus interest, plus medical expenses, plus other items, if those exceed that $27,700, then it would be beneficial for you to take the itemized deduction. But generally, I think most people are better off taking the standard deduction.
Do you need to save all of your receipts still or not?
It would still be good to retain your receipts if you are contributing large sums of money to a charitable organization, to a church, to a nonprofit. You should be retaining some sort of receipt for that. Any taxes that you pay to your state should also be easily documented.
The next thing we'll cover is taxable versus non-taxable income. Now, many assume that all income is taxable, but that is not true. Can you share some examples of income that is taxable versus income that is not taxable?
So income that is taxable is anything that you've earned, say money coming in from a 1099, some side work. Like for me, I'm an accountant. I consult for a couple of companies, so they will send me a 1099. So that's all reportable. That's all taxable income to me. Anything that is non-taxable, an example would be if a mother-in-law or father-in-law gives you a gift, or your mother and father give you a gift, that's not taxable. Child support payments are not taxable to you, the one receiving it, but it is the income that the other spouse receives or the other person is earning is taxable to them.
And I think a part of this too is that the government is pretty good about not taxing you twice. So if your partner is earning income, they would be taxed as part of their income, and then that money flows to you in terms of child support. The government will not double dip and tax you again on that support payment. So now, is it possible to reduce your taxable income? Are there ways that you can take that's legal with the IRS to reduce the income that can be taxable by them?
Yes. But I would say you can't really do it at this point for the 2024 tax year. You need to be proactive about doing it ahead. The benefits that you get from your employer, your 401k, your dependent care, your FSA, that all reduces your income. Think about it in November or October when you sign up for the following year. You want to be making those elections so that you're reducing your income for the following year.
That's a good point. So if you want to reduce your taxable income, good to check with your benefits first and sign up for those so that you can get the benefit of that, whether it's retirement, maybe you're putting money aside for like childcare or for transit, and then you can get the benefit at the end of the year when all is said and done, and reduces your taxable income or the income that could be taxed by the IRS.
The one other thing also that you can do for 2024 is you can make retirement contributions if you haven't met that threshold yet for 2024. So if you put money into deductible IRA, then that should reduce your taxes, but it's not like a 1-for-1. So if you put money in for $1,000, it's not going to reduce your taxes by $1,000.
Well, let's cover that, because the next thing that I think that most people don't understand is, or at least like we're not really taught a lot of this stuff and we don't see it on our day to day. It's like taxes are taken out of our paycheck every week, but it's only once a year that we get to really see how taxes is being done, like when we file for taxes. So can you talk about tax credits versus tax deductions, and how we need to look at those two items when it comes to our taxes.
So tax credits will reduce your taxes dollar for dollar. If you look at $1,000 tax credit versus $1,000 tax deduction, $1,000 credit will be a lot better than $1,000 tax deduction, because a deduction is essentially lowering your taxable income, but you're still applying that tax rate. So essentially, if you're reducing your income by $1,000 in deductions, if you're in the 22% tax bracket, you're saving $220 in taxes, whereas the credit will actually save you $1,000. So the credit is one for one. If you have a $2,000 tax liability and then you get a $1,000 credit, you're essentially left with $1,000 still to pay.
It's great to understand the difference between credit and deduction so that when you finally see the full itemized of your taxes, the impact of each on your final amount, whether you're getting a refund or you owe money. Can you speak a little bit more to maybe the top 3 things people should be doing to ensure their taxes are filed properly or they get the refund right away?
I think first and foremost, you need to gather all the information, have a checklist handy. So what I do when I prepare our taxes, and we actually have an external tax preparer. So I actually put in like a checklist of what items we had last year and then notate any changes that have happened throughout the year. You're going to be your greatest advocate for when it comes to tax information. So you need to be able to provide all the information to your tax preparer so that they can file it correctly. I have a little bit more of an accounting knowledge since I prepared tax returns before. So it's also good to be able to review your tax return and see what changes have been made and ask questions to your tax preparer to see what's changed for this year versus last year. It's good to be curious and be able to review your tax return. That way you have a better understanding of why you have a larger refund or why you don't have a larger refund compared to last year. I used to really hate filing taxes when I did it myself, but at the end of the day, you just have to bite the bullet and just do it. So gather your information, send it over to your tax accountant or file it through TurboTax or whatever you need to do to get it done and clear it out of your head.
That's a good idea. I think sometimes the deadline feels far and the timeline for getting your taxes submitted is very long, especially on January 1st and then April 15th. Many of us can delay, and it keeps hanging over our head and we can get stressed out over it. So it's a good idea to submit it as early as you can once you have all the information and you've compared it to last year's so that you are better prepared. Can you share some more resources that other people might be able to tap into just to learn more about taxes, as well as learn about what they might qualify for as far as credits or deductions?
So I'm going to say this isn't the funnest website, but the IRS does give you some pretty good tools about figuring out if you can take a certain credit or not. It'll take you through a different questionnaire, and question by question, you can say yes or no and follow the different prompts. And it should have like information on there too about what certain things mean. So that should be a helpful tool if you ever want to look into a credit that you may or may not be eligible for.
One of the things that it's also good to understand with taxes is that it is part of our lives, right? We have to file taxes every year if you have earned income, and it's really how the government gets their money. It's that income coming to the government. So it's a necessity that we all file it. But because we're only doing it once a year, it can get confusing and stressful during this time of year. So I would prepare ahead of time, get to know a little bit about what taxes mean. Maybe you can grab a book from your library. This one is what I would recommend, is very straightforward. And this one too, you can get it for free at your library and read about it and see what else you can learn about taxes. Unfortunately, many of us probably never took a tax class. I don't know how common it is, especially for me. I've never taken one when I was in college, so that was pretty surprising. So when I finally became an adult now in the real world, I really had to make the effort to learn about taxes. And also, thankfully, I have my sister on hand to ask those questions. But if you don't have that, then you need to find a professional, or you need to really do the research on your own so you can get the right info to really help you save money on taxes and get you more money for your family. Thank you for tuning in to Sisters for Financial Independence, where I cover topics related to money, motherhood, and everything else in between. If this video has been helpful for you, give it a like and share it with a fellow mom. And a reminder that it is illegal not to file your taxes. If you are not filing because you are worried about owing the IRS, please consider the future of your family. File your taxes and work with the IRS to figure out a repayment plan to pay your taxes. Please do not put your family's future in jeopardy by ignoring the laws. And if you're working to figure out what kind of employee benefits will reduce your taxable income and keep more money in your pocket, this video is for you. And if you're serious about getting out of credit card debt, this whole playlist can show you how. Thanks again for tuning in, and I will see you in the next video. Bye!